Welcome to Money Manager in the Joburg studios. Leon Ferreira, who's a director of PSG Consult. We're not going to talk about a specific fund this evening. We're going to talk about the general principle of PSG Consult and the way it manages money. Leon, you've got around 7 billion in your division under management for institutions and also private clients. And I looked at your top 5 holdings, and it's, although I might say it's pretty standard stuff, it's obviously served you well. Big names, good track records, etc.
That's right, Lindsay. I think it's a pretty simple philosophy, and that is in investing in quality companies. And I think looking at management actually to look after our money for us. And I think it's all about the quality of the companies. When markets tend to be a bit volatile, we derive some comfort from the quality of the companies that we are invested in.
Yeah, we'll come to those top holdings later on, but just talk about the philosophy. You've sort of given us a hint of the philosophy, but what's the mandate for your funds? As I've said in my introduction, we're not talking about a specific fund now, but what's the general philosophy of PSG Consult?
Well, in the first instance, I think it's a long-term philosophy. I think all our clients are in it for the long term, so we tend not to look at movements in the markets too much. I think a lot has been said recently about volatility in the markets, fears about Greece, problems about rising interest rates in America. And when we tend to look past that and look at the companies themselves, I've mentioned the good management, and also the fact, if you look at the top 5, or most of our companies are actually holding companies that have a portfolio of different companies that they look after. And most of those bigger companies also tend to have an offshore activity as well, where they derive income from. And I think our portfolio is probably skewed to those international companies that are globally active.
Yes, indeed. And of course, you will probably be using your 25% allowance for offshore investors as investments, rather, as well as the fact that you're investing in JSE listed companies that have operations overseas.
That's right, Lindsay. We have local portfolios, and then we also run offshore portfolios. And obviously, you also aren't necessarily limited to the 25%. You can actually, by asset swaps, actually increase your offshore exposure. And most of our clients have a more or less 30 to 40% offshore exposure at the moment.
If you could go higher than 30–40%, this is a sort of an unfair question, but I think quite a valid one these days, given the fairly parlous state of the South African economy. Would you go higher than 30–40% if you were allowed to?
Well, as I said, we are actually allowed to, but I think most of our clients, you always have to take the currency risk into account. And I think I'm pretty comfortable. I think as a general rule, any investor can have probably 30, 40, 50% of his assets offshore. It makes sense because of diversification and the fact that you can invest in companies that you don't have access to in South Africa. So as a general rule, I think probably up to 50% we'd be quite comfortable with. I think people who live in South Africa and are going to stay here forever, you have to take account of the currency risk, and specifically people who eventually will have to derive an income from those assets. You need to be careful to not just have all your assets offshore. There is a risk involved in that as well. Let's
talk about a general asset allocation principle now. The equity market is 6¼ years into a bull market. It started in March 2009, and obviously there's been pockets of weakness in certain parts of the world, but generally speaking, we've been going up. The JSE has had a little bit of a tough time recently, but let's say that we're still in a bull market. Does that mean that you are heavily weighted toward equities in your asset allocation model?
Yes, I think when I speak specifically just about the equity portfolios, those are portfolios where the clients have already allocated their assets. We do it on their behalf. We'll have enough in fixed investments or government bonds, for example, to take care of those income needs. So when specifically as far as the equity portfolios are concerned, those are long-term investments. We don't care too much about the movements in markets. And I think you mentioned at the moment that the morale is, or it's pretty bad, the morale is regarding investments, and there is almost a clamor for everybody to invest everything offshore and to go offshore. And it reminds me a bit about of the time in 2000 when there was quite a run for offshore investments. And I think one needs to be careful and stand back a bit and just see whether does it make sense. And we really think that our market is not cheap at the moment. Some of the equities actually look expensive. So we do see value in America and also in Europe. And I think those economies, the underlying economies, look pretty healthy at this moment. So we have, we would like to invest in Europe and in America at this stage.
Yeah, the American story is a good one because I think Janet Yellen is just about managing this interest rate situation beautifully. She says that the economy is picking up, but now she's put in another little caveat. She's saying when inflation is consistently at around 2% or 2% plus in America, then we'll think about raising rates. So she's gone from unemployment and she's gone to inflation, she's gone to jobs. It's all sorts of different metrics that she's putting forward as a reason for not raising rates. But anyway, rates haven't been risen, and we can expect the US economy, I think, to tick along quite nicely. Let's go back to your top holdings now and have a look at them. And of course, a proudly Cape Townian company, which is a global player now in anybody's books, and that is Naspers. You must have had a few times when you thought, when it went to 2000, let's trim our position a bit. What's your position now?
Yes, Lindsay, it's a funny one, Naspers, because you know, the value managers will say, well, it's trading at such a high PE, but I think you need to look at it. It's also almost an investment company, and the biggest investment underlying is Tencent, and we see value in that company. We see the way that spending takes place in China. It's all driven through the internet. I think you've even seen companies like Unilever reporting that they have problems with their selling in retail, and all the more people using the internet to shop. So I think that's a very good story to tell. And if you look at a valuation, you need to be careful. The P is pretty high, but they are pushing all the expenses through the income statement, so you can't really just look at it on a PE basis. And we're pretty happy with the investment. We have trimmed it from time to time. We don't like to hold any company with a larger holding of, say, 10% in a portfolio. So we have trimmed it from time to time, and I think it just makes good portfolio management sense to trim from time to time. But we're quite happy with that holding, and we'll probably keep it for quite some while. I think our approach is to buy a company and actually allow the management to do their job and hopefully keep that company just about forever.
Yeah, I think so. I think if you could keep it for your investment life, then I do think that you can't go wrong. There'll be a few hiccups here and there because of the nature of its investment in Tencent and that rather volatile economy that is China. But yes, I quite agree with you. Let's just go up the highway now from the CBD of Cape Town to Stellenbosch and go to Steinhoff. And your company, of course, PSG. Start with Steinhoff.
Well, Steinhoff, it's also, you know, based largely in Europe. It's almost this, well, it is the second largest furniture retailer in Europe, just behind IKEA. And we like the company for, management has done well with the acquisitions, Conforama, the big one a few years ago. And with the Pepco acquisition as well, now they've added clothing as well. And they've always been in not the high end of the market. It's more almost like the discount part of the market. And in these times, and they've actually done exceptionally well. So we're quite happy with that exposure, and specifically now with Pepco coming along. And I think there is still some scope for further expansion. For example, just in Poland is one example where they can actually expand their footprint as well.
Yeah, I do think that if you service the low end of the market, then it doesn't matter how much world GDP is growing, whether it's at 2% or 5%. The wealth gap between the very rich and the very poor will always be there, and it's widening all the time. And there will always be a sector of the market at the bottom end that needs servicing. And I think companies that do it correctly will always do well. What about your company, PSG Group? That's an amazing story.
Yes, it is. Unfortunately, you know, we haven't been afraid of holding the company. I think you might, in bad times, you know, your clients might ask questions about why you are holding this company. And we've always liked the PSG story. Jannie Maton has really built up a great portfolio of underlying assets. And once again, the theme of allowing managers to do it on our behalf, you know, making acquisitions. And if you look at the underlying portfolio of Capitec and Zeda and Curo and then PSG Consult, that's a great, wonderful portfolio that they have. And I think what we allow them to do is simply just go about their business. And we feel ourselves as partners actually of that company, and it has done for us extremely well. I think PSG over the 15 years has almost been the share on the JSE that has given the best value to accumulated growth actually to investors over that period.
Let's go outside of the top 5 and outside of the top 10 if we can. I mean, if you look at Steinhoff, the way it suddenly took off, I think it was around 15 to 20 rand a share, and then suddenly people started to realise what Steinhoff was and understood it, and therefore a whole legion of investors suddenly piled into it, and it's done well since then. Is there anything outside of the top 10, anything on the fringe that you're looking at which says to you this could be the next Steinhoff, it could be the next Naspers?
It's become a bit difficult. I think, example is Brait. We bought Brait a few years ago for that Pepkor interest, which we thought wasn't valued correctly, and it has actually paid off quite handsomely for us. We stayed away, and we have a small exposure to commodities. I know that value managers have been looking at commodities, and we just don't see the earnings. And we like earning surprises, but on the positive side. And so I think we've steered clear of that. There might be a time that really does become extremely attractive, but we have remained underweight for quite some time on that. And we really don't want to move out of the top 100. I think the smallest company probably we have is Supergroup, which has also done extremely well for us. And we are heavily exposed to banks through Remgro, the interest in First Rand, and FNB and RMH. And then obviously we also hold Old Mutual, and we have the Nedbank exposure through Old Mutual, and then also Investec. So fairly heavily involved in banking, and then of course Capitec through PSG. And that's held us in good stead. And if you look at the average PE of the financial sector is about 13, which makes it not expensive at all, and we see a lot of upside there. But I don't think, it's so difficult, and finding those little small cap stocks, we'd rather leave it, I said, to our bigger companies, let them go find those smaller companies and make the acquisitions, and then have us involved in looking for that.
Leon, thanks so much for your time this evening. That's Leon Ferreira, who's the director of PSG Consulting.